All right, today we're digging into Datadog, a true giant in the world of cloud monitoring. And on the surface, this is just a massive success story. But there's this weird paradox lurking just beneath those stellar numbers, one that has Wall Street feeling a little uneasy. So let's break it down.
And that right there, that's the central question, isn't it? We're talking about a company that is firing on all cylinders, truly an elite player. So, why all the mixed signals from the market? Let's figure out what's actually going on here. So to really get what's happening, we have to start with the good news. And trust me, it is very good. In the last quarter of 2025, Datadog's revenue just shot up, growing over 29% from the year before. I mean, that is just strong, healthy growth, especially in such a tough market. And if you thought that was impressive, get a load of this. This number is all about long-term confidence from customers. It's the value of future contracts they've already locked in, what's called RPO. And it surged by a massive 52%. We're not just talking about today's sales. This is proof that big-time companies are signing multi-year deals, betting their futures on Datadog. And on top of all that, the company is an absolute cash machine. Seriously, a 31% free cash flow margin? That's elite territory. For every single dollar that comes in, almost a third of it turns into pure cash. It's a sign of just incredible efficiency. So the picture looks perfect, right? Flawless. But then you see this.
And there it is. That's the record scratch. After putting up almost 30% growth, the company's own forecast for the next full year suddenly drops to just 18 to 20%. And that sudden slowdown, that is the entire reason Wall Street is so anxious. It's the first real crack in that perfect facade, and it's what we need to unpack.
But look, before we get into all the risks, we really have to understand why Datadog is considered such a beast in the first place. So let's start with the bull case, the undeniable strengths that make this company a true powerhouse. This chart right here, it perfectly shows their killer land and expand strategy. See, they don't just sell you one tool, they sell you the whole platform. A stunning 84% of their customers use at least 2 of their products, and a full third of them are using 6 or more. Once you're in their ecosystem, you just get pulled in deeper and deeper. It makes their platform incredibly sticky and almost impossible to leave. So, for anyone who follows software companies, there's this key benchmark for health called the Rule of 40. It's pretty simple. You add the company's growth rate to its cash flow margin. If that number is over 40, you've got a top-tier operation. Well, Datadog doesn't just pass this test, it absolutely crushes it. It proves they can grow like crazy and be incredibly profitable at the same time. The whole bull case really boils down to 3 big things. First, companies are getting tired of juggling dozens of different tools, and Datadog is the #1 choice for consolidating. Second, the AI boom is creating a massive need for monitoring, and Datadog's own AI is already a huge player. And finally, with billions in locked-in revenue and cash in the bank, this company is a financial fortress.
Okay, so that case for greatness is really compelling, no doubt about it. But it still doesn't explain that sudden cautious forecast. So now it's time to flip the coin and look at the other side, those cracks in the armor that have investors so spooked.
And this is the big one. According to analysts, a single customer, OpenAI, could be responsible for as much as $300 million of Datadog's revenue every year. Now, that's an amazing contract to have, but it's also a massive concentration risk. What if OpenAI decides to build its own stuff or just gets really aggressive about cutting costs? It could blow a giant hole in Datadog's revenue. And that dependency is a huge part of that conservative forecast.
The other major issue here is the price. I mean, you are paying a serious premium to own Datadog stock. As you can see here, it's trading at around 12 times its annual sales. Now look at its closest rival, Dynatrace. They're growing just a little bit slower, but their stock trades at about half that valuation. It just means expectations for Datadog are sky high, and there is absolutely no room for error. And you can bet the competition isn't just sitting on the sidelines. This quote really gets to the heart of a new kind of threat. See, Datadog's pricing is all about consumption. The more data you use, the more you pay. But a new competitor, Chronosphere, which was just snatched up by Palo Alto Networks, is built from the ground up to help companies send less data. It's a direct attack on Datadog's core business model. This table gives us a great snapshot of the battlefield. Datadog's biggest strength is its massive all-in-one platform, but it is fighting a war on multiple fronts. You've got Dynatrace competing on automation, Cisco's Splunk as the old guard in security, and now Palo Alto with Chronosphere attacking them directly on cost. It is a brutal environment out there.
So, we've got an elite company facing some very real, new threats, all while carrying a sky-high valuation. How do we solve this paradox we started with? Well, the key is to understand that the company and the stock are two very different things.
And this gets us right to the heart of it. Let's be clear. Datadog is a phenomenal, best-in-class company. The problem is that its stock is priced for a level of perfection that might not be possible. The current valuation basically assumes everything will go perfectly, and it kind of ignores these real risks we've been talking about.
And all of that leads to the final verdict from the source report, a hold. Now, that's not a call to sell because this is a fundamentally strong company, but it is a big warning that right now, the combination of that high price and these new risks makes it a tough bet for new money. The advice is basically to wait for a better entry point. So what's next? The story is far from over. Let's look at the key things coming up on the horizon that could either confirm the market's fears or prove all the doubters wrong. First, let's just zoom out to the big picture. The entire market they operate in is getting way, way bigger. Gartner is forecasting that total IT spending will hit over $6 trillion in 2026. You know the saying, a rising tide lifts all boats? Well, this is a massive tidal wave, and it's a huge tailwind for everyone in this space. More tech just means more stuff to monitor. And here are the specific dates you'll want to circle on your calendar. The Q1 earnings release in May is going to be critical. Everyone will be listening for updates on that big AI customer. Then in June, Datadog has its big conference, Dash, where they'll probably announce new products to fight off the competition. And later in the year, new AI rules in the EU could actually make platforms like Datadog mandatory for compliance, which would be a huge new driver for their business. Which brings us right back to our central dilemma. Datadog is an A-plus company, no question, but it comes with a serious price tag, and it's trying to navigate both the huge opportunities and the unique risks of this new AI era. So the fundamental question for any investor remains, in a world this fast-moving, is perfection a price worth paying?